A surprisingly large number of people are speculating in the financial markets. They're not only trading in cryptocurrencies, but also seeking out lesser-known companies in the stock market in hopes of hitting it big. This kind of behavior stems from the desire for significant returns, to make a lot of money. Maybe you too have already used that sort filter feature of your trading platform so you can see which are the top gainers, the top losers of the day. If that sounds like you, then you're trying to do is to find assets with high volatility. You're hoping to multiply your capital quickly. However, if you don't have mastery of the concept of liquidity, this is risky, and we need to explain why. Money Arata. Now let's imagine that you are at a busy marketplace. You can see many vendors with piles and piles of potatoes. See, you can go there, you can buy as many potatoes as you want, and still you won't be able to make a difference in the price. The number of potatoes being offered is so big, it doesn't matter. You alone will never be able to buy a significant amount of the total number of potatoes to change the price of the market of potatoes. The potatoes here represent a liquid market. In the liquid market, there are many items. It is easy to buy or sell without changing the price. Now let's take a look at another vendor. He's selling fresh lobsters. He only has a few. And depending on the time that you go to visit the market, the price of these lobsters will be different. Lobsters here are representing an illiquid market. The lobsters are scarce. Buying or selling can cause a big change in the price. If many buyers show up early in the morning, and if the seller wants to take advantage of the situation, the price will probably go up because there will be fewer lobsters left. But on the other side, if few people buy early in the day, that seller might start to give big discounts later because he has to sell those lobsters while they are still fresh. In trading, understanding liquidity is like having a map in this marketplace. It will help you to guide your decisions, it will affect your potential profits. Also, it will help you to see the risks. An illiquid market might promise you some high rewards, but also comes with high risks. The price might change a lot. Your expected profits can turn into big losses quickly. And that is why it's so important to understand liquidity before you trade. Now attention, this is not financial advice. Please read the full disclaimer before proceeding. Every investor needs to know the minimum about liquidity to be profitable. So let's start with a quick definition. Liquidity is how quickly and easily an asset can be bought or sold in the market without affecting the price of that asset. So when an asset has high liquidity, it means you can quickly sell or buy it without making the price swing too much. On the other hand, an asset with low liquidity, it can have its price shoot up really quickly or go down dramatically, even with just one big single buy or sell order. Now, how can you tell if the asset that you want has good liquidity? You can take a look at two things: the trading volume and the bid-ask spread. High trading volume and a small bid-ask spread will show you good liquidity. What does that mean? Trading volume is just the number of shares, the number of contracts that are being traded within a certain time frame. So if a lot of trades are happening very quickly, that is high volume. Now, the bid-ask spread is the gap between the highest price that a buyer is ready to pay, that is the bid, and the lowest price that a seller is willing to take, the ask. If the difference between these two prices is small, that is a good sign of liquidity. And why does liquidity matter? It's all about price impact. In markets with low liquidity, big orders can make prices jump or drop unexpectedly. This is also known as slippage. This is the gap between the price you thought you would be going to get in a trade and the price you actually get. High slippage can eat into your profits. It can even lead to unexpected losses. In the Diamond Hands training, you'll have access to a detailed set of activities so you can learn how to calculate your slippage, and you can see everything going to arata.se/Diamond Hands. Now keep in mind that liquidity can vary depending on the time of the day and what's happening in the market. If it is daytime in America or Asia, those traders could be affecting the liquidity. Other factors, like big news events or sudden market swings, can also have a big impact. Different assets will have different levels of liquidity. For example, major stocks, major currencies often are more liquid than maybe some real estate or rare collectibles. But be careful, there is a common mistake here to classify real estate as illiquid and stocks as liquid. It depends. When you start to research about liquidity, you might find many examples saying, for example, real estate is less liquid than stocks. At a basic level, yes, that is correct. Indeed, selling a property usually takes longer than selling stocks because real estate involves advertising, contracts, inspections, and often mortgage approvals for the buyer. And on the other hand, selling stocks can be done quickly with just one single tap on the button of your trading platform, the app you use. However, that's not the full story. Just imagine that the stock market is temporarily going down, prices are dropping. Suddenly, maybe you need money for whatever reason. You could sell your stocks quickly, but you will have to do that at that bad moment at a lower price than you would like. Despite you doing your fundamental analysis showing that your investments should be worth more, the prevailing market sentiment may have caused a big drop in the prices everywhere. In times of market turbulence, there may be more sellers than buyers pushing prices down further. So although stocks can be more liquid in the sense that you can sell them really fast, the amount of money that you will receive will be sometimes less than you would like because of the lower prices. And in a similar way, if you're trying to sell a house during a downturn in a stock market, maybe it will take you some time to find a buyer. However, probably you will not have to reduce your price so much, particularly if your property is amazing, is desirable, it has a great location. And this is because the real estate market doesn't usually fluctuate as rapidly as the stock market. This lower pace can provide you a little bit of protection against the short-term market volatility. So the liquidity of an asset is not just about how fast you can sell, it is also about how much money you get, the price fluctuating when you sell or you buy. This is a crucial concept to grasp when you're deciding where to invest your money. It serves as a reminder that successful investing is not just about following the herd or adhering to some oversimplified advice. Instead of that, it requires you to really understand the concept, the subtleties of different markets, and making informed decisions that really suit your individual circumstances. Liquidity is how easily an asset can be bought or sold in a market without affecting the price. So once again, to make it really easy for you to understand, imagine you are at a fruit stand. You want to buy an apple. If there are hundreds of apples in that stand, you can easily buy one without affecting the price. But if there is just one apple left, and there are many people who also want to buy that apple, they will start to make higher offers to the seller and the price will go up because of that limited supply. In this scenario, a stand with hundreds of apples is more liquid than a stand with just one apple. A market with only one buyer is less liquid than a market with thousands of people walking around and trying to buy things. Now, let's apply this concept to the financial market. Highly liquid assets have many buyers and many sellers. For example, you can take a look at stocks of the big companies with big market capitalizations. Large market cap often correlates to a high level of liquidity because typically there are many shares available for trading, there are many buyers, there are many sellers in that market. That is why stocks of companies with a large market cap like Apple, like Microsoft, or the market for Bitcoin tend to be highly liquid. There's simply more participants that are trading these assets, and that has an impact on the price movement. On the other hand, illiquid assets have fewer buyers and fewer sellers. These could be stocks of smaller companies or some cryptocurrencies that nobody knows about. When you try to buy or sell these assets, you might significantly affect the prices because of the limited number of transactions. In the Diamond Hands training, we'll do activities together so you can clearly see all of that, and you can also calculate your risk for better trading. And you can start right now going to arata.se/Diamond Hands. Liquidity impacts your ability to enter and exit positions. So now you can see what liquidity is and why it is important. Liquidity impacts your ability to enter and exit positions. If the asset is illiquid, you might not be able to sell it when you want to, at least, or maybe you might be able to sell it, but at a lower price than what you would like. Illiquid assets often exhibit higher volatility, because with fewer transactions happening, the prices can swing dramatically, leading to have potential losses or potential big gains. At a first glance, you might think that, wow, yeah, that sounds good to me. Volatility is just what you want. After all, the volatility is the magic ingredient that can actually multiply your money, right? However, this is the kind of volatility that comes with a higher risk. Illiquid assets are more susceptible to market manipulation, like wash trading, where just a single trader can create a false impression of a high trading volume, enticing other investors like you to join and artificially inflating the price. Because of the low trading volume, illiquid assets experience more pronounced price fluctuations, and this occurs because with fewer transactions, fewer participants in the market, each trade has a much larger impact on the price of the asset. Now keep in mind that not all volatility is equal. In the case of illiquid assets, often that represents a higher level of risk. This is very important. You must be able to distinguish between natural volatility and manipulated volatility. The natural volatility occurs in liquid markets with large market caps with many different participants. This type of volatility is an inherent aspect of markets, and it reflects the ongoing process of price discovery. Because as new information is entering in the market, the participants reassess their valuations of the asset. It causes the price to fluctuate. This is a healthy, normal part of trading. Now, on the other side, manipulated volatility is common in illiquid markets, where the majority of the asset is controlled by a small group of individuals or entities. They are often insiders, such as the issuers of the stock or the token. And to understand all of that, you can see how Bitcoin is different from cryptocurrencies in the episode number 38 of the Money Arata series. For example, some cryptocurrency creators keep a very big portion of tokens for themselves from the very beginning. This is a practice known as pre-mining. This means they have a significant ability to manipulate the price of the token. If they decide to sell a large quantity of that asset, the price will plummet. If they buy, the price will skyrocket. And as an outsider, you are at a disadvantage because you don't have the same level of influence or access to information. These swings are not just about normal market dynamics, it is about the moves of very few participants. This makes it a very risky proposition. So always be cautious when you're investing in illiquid assets. Understand the risks and be prepared for potential price swings. I'm going to give you now 5 practical tips for you to remember. Number 1, check the trading volume. This is the most straightforward method. Look for the 24-hour trading volume of the asset that you're interested in. If it is high, that generally means that a lot of people are buying and selling. It indicates a liquid market. Number 2, examine the order book. Look at the number and the size of the orders at different price levels. If there are only a few orders, or if the orders are small, the asset might be illiquid. On the other hand, a lot of orders at various price levels will suggest a more liquid market. Now, just keep in mind that the order book can sometimes be misleading because of practices called spoofing, hidden orders, iceberg orders. Spoofing is a deceptive strategy where an investor places orders with the intention to cancel them, spoof, before they are executed. This creates an illusion of high trading volume. Hidden orders and iceberg orders are trade orders that basically pretty difficult for you to see, and they can distort the true picture of the supply and demand. Now, number 3, look at the spread. The spread, you remember, is the difference between the highest bid, the buy order, and the lowest ask, the sell order. In a liquid market, the spread is usually very small because there are plenty of orders that are close to the market price. A large spread could indicate an illiquid market. Number 4, watch the price chart. Sudden, sharp price movements can indicate low liquidity. If the price chart is more smooth, more consistent, that often suggests a more liquid market. Now, number 5, beware of newly listed assets. They can be particularly illiquid because they are yet to attract, to get some people interested, a broad range of investors. If you don't know what you're doing, it might be wise for you to wait a little bit until your asset establishes a more solid trading history before you jump in. Remember that trading in an illiquid market can be risky, so it is crucial for you to do your research and understand the market conditions before you place your order. To have detailed guidance and practice with me and receive feedback to make sure how to put all of this into practice, you can now visit Diamond Hands, where we have a special class available for you at arata.se/diamondhands.